Okay, I guess now we are broadcasting. What is that room on the TV? It turns on. Hang on a minute, we'll do it like a couple of minutes. Okay, we did not wrap up problems from chapter 11, I don't think, the other day. So what problems were due in chapter 11? Lindsay, do you have those?
No, I do not.
You don't? All right. Susan, what problems did we have due in chapter 11? I know we should have had problem 1.
2A and 5A.
All right, we did not go over 1A, did we? I'll look at 1A again, and we had 2A and 5A. That is payroll entries. Now we're going to gear up for a test, hopefully by next Thursday, but we might not be able to achieve it. It won't be any later than the next Tuesday. But we went through chapter 12, and I lectured on it the other day, and I hope you could get that. So let me tell her.
We did go over 1A.
We did?
Yeah.
Okay. What's in here? Hey, Teller, come on down. So we'll have some coming in late, probably. Tell her. So, anyway, if I were a student, nobody in that room, I'd check to see where bodies were. But some people don't think of that, do they? Anyway, we looked at problem 1. I'm going to review that with you real quick again, if I have it here. Somehow or another, this thing even lost all my solutions. I had to put them on a jump drive. So these things are probably pretty good, but we're going to have some problems or glitches. Karen Grogan couldn't get the sound to work in 208, but it worked for me, but it didn't work for her. So on. So it works for some and it don't work for others. All right, reviewing that problem 1A, but briefly, we purchased merchandise inventory on account. We couldn't pay the account on time, so we gave a note. Now, this company, Lamy Company, can draw interest. We paid the note. Notes payable $240, interest expense $800, and cash credit. All right, and May the 1st, it looks like we borrowed money from the bank with debit cash and credit notes payable. And on June the 1st, we bought some tools here, but they built in interest. All right, interest is built in on this $180,000. So how much interest was on that $180,000? $1,500. We pay that in advance. The tools really only cost $178.5. Debit interest expense and credit notes payable. So here you have a pay interest at the maturity date. Here you pay interest at the starting date. Ending date, interest expense, starting date, discount. All right. So you'll need to know those entries for the next test. All right. And here we paid off this note, but we didn't pay it off. What happened here? Cole, what happened here on the 15th of June? What happened?
It says they renewed the loan by issuing a new 45 days.
Right, they couldn't pay that note. So they gave another note, 160, canceled out that note, but they did pay the interest they owed of $1,000. And then on July the 30th, it looks like we discounted, no, we paid a note. We got rid of that $160,000 note, finally paid $1,400 interest and credit cash for $161,400. Here's another notes payable and credit cash. We borrowed money. No, wait a minute. We paid off that note that was discounted, this $180,000. All right, we paid off that note. And here we bought office equipment. We gave a note for $300 and credit cash. This is an interest-bearing note, not a discounted note. And then we have notes payable, $30,000, debit interest expense, and credit cash. Now that was pretty much number one, except warranty expense. And we had product warranty expense debit and credit to warranty payable. All right. And here we had an adjusted entry on this note. All right. 30 days, whatever that note was for. So we got interest expense and interest payable. All right, let's see. How much that was and what? 30,000 times 9 times 5% times 30. That don't make sense. All right, where did the 300,000 come from? For this entry, problem one. It says interest on the 9 remaining notes owed to Warwick Company. 9 remaining notes. How much were those notes a piece? All right, they were 30,000 a piece, right? Yeah. Right here. There are those notes. Now, there's 300,000. We paid off one note, right? Okay, now let's take 270,000 and multiply it by 5%. Take 270,000 times 5%. All right. And we owe interest on that one note. It's an adjusted entry. And multiply that by 30 over 360. We owe interest for 1 month, 30 over 360. That should give you 1125, correct? All right, let me check the run briefly. I guess you all are in today. Susan, you have a blank sheet of paper. That's right. Take the phone. About 8 out of 18, that's only 50%. Now, 3 of you showed up the other day, Jonathan Cole, who were the Haley gal. She was live streaming this morning. So, and we did get a memo not to count you all absent that day, so I won't count against them. if you were live streaming that day, I wouldn't have canceled it. Anyway, if you were live streaming at that time, but we got a memo not to count anybody absent. We definitely should have had a inclement weather policy, but we didn't. All right, did you get 1,125? That's all we were doing there was an adjusting entry. All right, I asked you to do problem 2. We need to wrap up this chapter quickly. So you see what problem 1 was about. Notes and interest. It'll be on your test. Notes and interest. Now what's problem 2 about? Payroll. And I've warned you about 2 main payroll entries. I hope this one has it in it. All right, we had salaries and we had deductions. They did all the multiplying for you. But your tax rates are Medicare, unemployment, and Social Security. All right, your instructions are assuming that the payroll for the first week of the year is to be paid on December 31st. Journalize the following entry. For the last week of the year, to record the payroll. All right, Lindsay, do you have that entry?
No, sir.
All right, Cole, do you have that entry? Debit what?
You debit sales salaries expense, warehouse salaries expense, and office salaries.
All right. Did you credit any of the deductions?
And you credit the employee's income tax payable, social security tax payable, Medicare tax payable, retirement savings payable, salaries payable, and group insurance payable.
And what was your salaries payable?
Salaries payable is $551,600.
All right.
So
Know that entry, folks. You will have it on the test. Guaranteed. Okay, know that entry. So debit salaries expense and debit warehouse salary expense and debit office salary expense. They gave you all the deduction and the net is take home pay. Okay. Now, if you did have to multiply, you had the rates. Maybe they didn't give them to you. Let's see. You had the 402 and the 210 deductions. You had the 135. They had all those done for you, didn't they? You didn't have to multiply. All right, they had them done for you, but you may have to do that. Now, that's one main entry. Here is the top debit of the next entry. How do I get payroll tax expense? All right, now, first off, on the test, I'm giving you some multiple choice. All right, what are the 3 taxes on the employee? Federal tax?
State.
Well, we can leave out state, but West Virginia does have state. There's 2 more there.
Social Security,
And,
Medicare,
all right. Now, what are the 3 taxes on the employer?
FIT something.
Well, 4 taxes, we're breaking down. 4 taxes. Social Security, Medicare. What's the other 2? State unemployment and federal unemployment. All right, so know those. Read the chapter. Okay, no. So your Social Security is just matching. You've already multiplied it out once. Your Medicare is just matching. You've already multiplied it out once. But now you may have to take the amounts. Since these are not on the total salary. Now, if I gave you a multiple choice question and said out of 4 taxes, SUTA, FUTA, Social Security, and Medicare, which one does not have a limit? You make $1 or if you make $1 million, you take out this tax.
Say Social Security, the option.
Which one?
Social Security, I would say.
Social Security has a limit. It's 100 and some thousand. SUTA and FUTA have a limit. About 40,000 here, but it's usually 6 or 8,000. Go first, if Jonathan went to work today, then pay state and federal unemployment tax on his first $6,000. Medicare tax on everything he makes. The Social Security tax on the first 100-some thousand. So Medicare is the answer to that question. There is no limit. Donald Trump makes $1 billion, he pays Medicare tax on $1 billion. Okay? Okay, so that wraps up, hopefully, the first two main entries in payroll accounting. So do know those. All right. What was part two of that problem? Assume that the payroll for the last week of the year is to be paid on January 5th of the following fiscal year. Journalize the entry. Now, here, we look at this entry up here. If that were the same entry and you were not going to get paid until January the 2nd, all those debits would be the same. All these let me let you look at it. What changed? What changed? Still payable, isn't it? As long as you got payable there, nothing changed. Now, 60,675. All right. Now, if we have to double up here, 60,675. If you had that posted or didn't have it posted, and was two pay periods, and all those would be double. All right, but Medicare tax payable still the same, Social Security payable still the same, federal unemployment tax. Now, what changed was your federal and your state and federal, because it's the end of the year and you owed more. So please read part two. All right, now we didn't have 3A, correct? Some of you should work that one. That's wage and tax statement, data, employee FICA tax. All right, did you have number 4? That's a payroll register. I do not believe in doing a manual payroll register anymore. Because computers make it so much easier. Now, in the accounting program, we have what's called, I forget the name of that. It's computer application to accounting. And we've been doing something like flow charts and so forth in that class. I believe Mr. Hamel wants to change it to teach you some Excel, and we already know Excel. Peachtree, that's a good accounting program out there in the real world. But QuickBooks Pro is an excellent program. So he may change that course so that you use real world software. It's like my tax files, we do real world taxes. Okay. You folks not watching today, hopefully you'll give me a summary. As far as I know, only one of you are present today, and that would be Haley. Haley's present, and somebody else, they didn't tell the name, this may be Anthony. But somebody else is live streaming. So 2 people are present out there today. So I have 10 out of 18 present. But everybody out there today, whenever you watch this video, today, tomorrow, whenever, please give me that 1-page summary. All right, that is a requirement. All right, number 3, I guess, payroll amounts and year-end entries. All right, we've got these account numbers up here and accounts already in them. We issued check number 410 for $3,400 to invest in a retirement savings account for employees. Okay, how about that entry, Jonathan? First one, number 3.
Where we at?
Wait a minute, number 5, I'm sorry, number 5. Got that, Debbie?
Use debit retirement savings deductions payable on credit cash.
All right, all you gotta do is take that to the bank and make the deposit, okay? Okay, second entry. We issued check number 411 to J Bank for $27,046. We're gonna deposit our Social Security, our Medicare, and our federal tax. Do you have that one, Miss Susan?
Social Security tax payable, I debit, 9,273. Debit Medicare tax payable, 2,318. Debit employees federal income tax payable, $15,455, and I credit $27,046. Cash, I guess.
Okay, thank you, Susan. If you're sitting in this room, you can't miss one of these monitors.
Is that cash? Should have-
Let me check, Susan. I got off on getting my roll call here. When you take it to the bank, you give them cash or they take it out of your account. What they do, they set it in the Federal Reserve System. They set in your Social Security, your Medicare, and your federal tax. The bank sends that in for you and gives you a slip that you paid. You don't have to send it straight to IRS or the treasurer. The bank does it for you. All right. Then we go down to the 14th, journalize the entry to record the biweekly payroll. Now, how often is biweekly? Every what?
Every other week, right?
Right.
Twice a month.
All right. Lindsay, would you rather be paid bi-weekly or semi-monthly?
Bi-weekly, because we used to be paid semi-monthly here, and we could only, the paychecks would sometimes be longer. So like, there's like 2 months out of the year that you get 3 paychecks. And when we used to get paid here at the 15th and the 30th, it didn't work as well. There's like 2 more extra paychecks a month, a year,
Under which method? Bi-weekly?
bi-weekly.
All right, semi-monthly definitely is 24 paychecks a year. Bi-weekly is 26 paychecks a year. Well, most people rather get paid bi-weekly.
It comes out to be the same amount, right?
Well, if you're on a contract for 50,000 a year, yeah, you either buy that for 26 or by 24. Yeah, you get the same money. But, if you get paid 500 a week, you know, you either get it 52 paychecks or 26 or 24. Anyway, negotiating a salary. When I came up here, I negotiated an annual salary, so it don't matter how I pay. We can elect, what, 9 or 10 months up here or twice. Whether they're teaching us something or not. Most people elect twice. But anyway, you were made an offer of bi-weekly or semi-monthly in a job interview, and it's the same amount, you definitely want bi-weekly, wouldn't you? Okay. Okay, from here, we go to journalize the entry to record the bi-weekly payroll. Monica, what you got?
Salary expense, office salaries expense, office salaries
How much was your salaries payable?
46,000.
I know they had those laid right out there for you, didn't you? Didn't you? You didn't even have to make the deductions. All right. So far, I can count on the front of the room to have their homework. Middle of the room sometimes. So far, the back of the room never. So it's changes, folks. Let's everybody have their homework. Okay. Have you got a book yet? Have you got a book yet? All right, they did put it out. I checked on it, make sure they did. I do have one on reserve in the library in case that's the route you have to go until you get one or whatever. But everybody needs access to a book. Now, I had a lady to come in yesterday. She's live streaming this class. She's never been in an accounting class. She took accounting 1 through some college. She had to finish it in 8 weeks. And she didn't feel good about it. And she probably got a good grade. But now, I will give most online classes, to get an A out of an online class, it's probably equivalent to a C in an in-class setting. Okay? So, I have one student that went to the dean yesterday to get a grade, transferred in one drop. What she did, she came here 4 or 5 years ago and took my accounting principles class. She got a D out of accounting principles. But she's came a long way since then. She majored in accounting and she pulled everything up. But what she wanted to do was for our dean to drop that class, which she got a D. She had taken the class before online and got an A. She should have transferred that A in to begin with and just audit 201. Just audit it. That's what they wanted this young lady to do yesterday, to audit 201, but it didn't work in her schedule. So she's going to struggle with 202. But she sounded like she's really going to work at it. That's what it takes. Because she's behind a lot of you all. So anyway, if you take the class, transfer it in, and it's a good grade, keep that grade. Audit another class you don't feel good about. So, but I hate that she's got a D now in principles when she could have had an A. But now, does that tell you anything about that class she got an A out of if she got a D out of mine? Does that speak high of that class that she took? Wouldn't seem to, would it? Okay. All right, so Monica gave you this entry. Again, debit all your expenses and credit all your payables and credit your take-home pay. Now, a business will turn around and debit salaries payable, credit cash. Now, this may be 40 employees or whatever. They've got to write out 40 checks. Now, some businesses keep a separate payroll accounting, bank account. Hopefully you never get a payroll check that bounces. That would be bad morale if the payroll check is no good.
Well, can your payroll checks bounce if it's like automatically and you're supposed to be transferred to your account? Could it still bounce technically?
If the employer did not have the money, it's supposed to go in your account at that time, but it won't if he don't have the money.
Would the whole thing not go in, or would just like what they had go in?
I'm not sure, probably nothing. The whole thing.
Oh, not good.
That'd not be good, would it? All right. Give you an example. You go to Walmart and you buy something, $50 on your debit card. But you've only got $25 on your debit card. You try to pay for that $50. Will they take it?
Yes.
No.
Mine will.
Sometimes depends. On if
Well,
you
they'll
have-
take it and give you the.
Yeah, like in that scenario, my bank would pay for it And if I didn't put like that extra $25 in the account within like 24 hours, they would take that and the additional 35.
Now mine's set up to where I can't. They won't reject it, because I told them I won't pay that $35 anymore, so, you can set it up like that.
Yeah, mine is too, a debit card, they'll take it out of another account. And they'll have it checked, they'll take out savings or something. Not putting it over, and pay those silly fees that is a waste of money flying out the window. Like a traffic ticket, it's a silly fee, isn't it? Waste of money, I bet, I'm sure, but they're a waste of money. Okay, to continue with this problem, on the 13th, we issued check 420 in payment of the net amount of the biweekly payroll. Taylor, do you have that one? No. All right, let's just go ahead and look at it. Debit salaries payable and credit cash is all you do. Now, on the 13th, you had to do your payroll tax expense again. All right, number one entry, number two entry. These others are minor. You're just getting rid of your liability. But you got two entries. One for the employees' deductions and one for the employer's payments or taxes. So employee taxes, employer taxes. We have not had a state tax here yet. All right, then we deposit Social Security, Medicare, and taxes at the bank, credit cash. Then we, medical insurance payable. We pay the insurance company for our employees' medical insurance. So that's on the 19th. The 27th, journalized entry to record the bi-weekly payroll again. Now we're going through all these again. You can look them up on Moodle. If you won't have time to just jot them down. All right, same entry. Same entry, same entry. Just make sure you do your calculations. But I want you to look at the 27th. What is the payroll tax expense on the 27th? 60 what? 61.35. Let's go up here on this other one and see what the payroll tax expense was. It was 62.65, meaning some of the employees have already met the $6,000 limit.
I had a question on I have quite a big question mark on the state, employment tax payable, federal tax payable.
Okay, what's your question?
Well, when it's the employees' deductibles, it's $3,501, and on the state and federal is $1,700. But when it comes down to the employer's expense, payroll expense, deductions, it's only $225 and $75 the same day.
All right, what Susan's talking about is what I was halfway pointing out, but I feel like I need to point out the whole thing. Now, here, your Social Security has to match what the employee paid. So the employer has to match that. Now, here are taxes just on the employer, and those two are different. Now, because of the $6,000 limit, if we go up to the first one, journalize the entry to record payroll tax. Well, they just flat out gave it to you, which is the 5.4% and the 0.8%, I think it was. Now, on the 27th, they did that same thing. They gave you the 225 and so on. But that's because they only pay taxes on the first, I think this book said 6, but I think it's 8. All right, so we make our deposits. We have salary again on the 27th. We pay it, and we paid the payroll taxes. Now, on the 27th, we do have employee state income tax payable and credit cash. So up here, did we take out a state income tax? We did, didn't we? All right. You can call this FIT payable, SIT payable, SUTA payable, FUTA payable, SS payable. Here you may have to spell it out. MC, not everybody don't know what MC means. Misinterpreted. All right, we're putting money into the retirement savings, credit cash. Now look at the 31st. Issued check 5 to pay bank to invest in the retirement savings. All right, that's on the 31st. Then look at this pension on the 31st. Paid $45,000 to employee pension plan. All right, so we debit pension plan expense and credit cash, but where does the $60,000 come from versus the 45? Where did $60,000 come from? They had to tell you, but where?
That's something that
We must have set up a payable.
match, like KO, 401k type thing.
Yeah, but did we have,
I don't see it coming out here.
but where does the 60,000 come from? I only see the 45.
It says the annual pension cost is $60,000.
The what?
It says the annual pension cost is $60,000.
All right, if it, what did it tell you that at, Lindsay?
The last one.
31.
Well, it did, didn't it? I overlooked the 60, sorry.
And then they only paid 5,000.
All right, they only paid 45, which is cash, and then unfunded is the other 15. And then we go again into accrued salaries payable, salary expense, salary. Now we'll wait probably until we pay them to take out all the taxes. And then there's vacation pay expense and payable. And that's pretty much that problem. If you can do that problem, you can do payroll, okay? If you can do that problem, you can do payroll. So please study that problem. Study problem 1, study problem 5, you got it made. It's got the warranty expense. The only other thing that might not be in there is a quick ratio, and I took those off the test. But let's look at a quick ratio at the end of the chapter for just a moment, and then we got to move on. We are finalizing this chapter, but I want you to look at a quick ratio.
Chapter 11 or 12?
Chapter 11, page 557. All right, we need to look at these. We will have a chapter this semester on payroll, on ratios. But if you learn a couple of them as we go, huh. All right, we got 3 little ratios here. Quick ratio, sometimes called the acid test ratio. Working capital is current assets minus what? I think I told you all that story about water closet, didn't I? WC can mean Wayside Chapel. WC can mean water closet in some other country. Okay. All right. Current ratio is current assets divided by current liabilities. That shows your ability to pay your debt. Now, quick ratio is quick assets divided by current liabilities. All right, that's the 3 ratios you need to look at on page 557. Okay, they're very easy ratios. All right, now the current ratio should be 2 or above for most companies. The quick ratio should be 1 or above for most companies. Now, the quick assets sometimes are, in this case, the quick assets was cash, temporary investments, and accounts receivable, but it did not cover inventory or prepaid expenses. So always take out inventory and prepaid expenses, and you got your quick assets. All right, just wanted to show you that. There was a problem. We didn't work it. There was an exercise. We didn't work it. I first had it on the test, which I already made up, but I took it off. But it wouldn't hurt you to be familiar with those. Okay, now that wraps up, as far as I'm concerned, chapter 11. We've got to move on. It's been about 3 weeks now on chapter 11. And given some of your time to get your books and so forth. All right, now let's get to chapter 12. Let me all right, I think I finally got it up there, but I have to have things on Jiffy drives, things on this hard drive, PowerPoint solutions for 3 courses now, what have you. So, but accounting for partnerships and limited liability companies. This is the only chapter you'll ever get on partnerships. For those of you who are accounting major, you'll get a little more on partnerships and advanced accounting. Advanced accounting, you'll get a little international accounting. All right. Accounting majors not for everybody, but accounting majors are usually some of our best students. And so I'm not saying we don't have good students in all of our programs. All right. There is 4 parts to this chapter. And one part is setting up a partnership with journal entries. And we've looked at that. The second part is splitting income according to any situation. And we've looked at that, and we did the other day. The third part is omitting a partner. He just gets cash and you omit him, or he buys out one of the other partners, part of his part, or whatever. And the fourth part is letting the partner withdraw. But there is a fifth part, sorry, liquidation. So you got to get a handle on these 5 parts of this chapter. And that's what we went over, these 5 parts of this chapter. Okay? Now, we went over all the PowerPoint yesterday, but a quick review of PowerPoints. We looked at some characteristics of a proprietorship and of a partnership. we'll get corporations in chapter 13 or whatever. Proprietorships of one owner. And we had some characteristics there. It has a limited life, limited capital. There's no taxes on any of these forms except a corporation. And we just passed a tax act that lowered the corporation tax from 35% to 21%. All right, characteristics of a partnership, about the same as a proprietor. And the mutual agency, remember that one partner's responsible for another partner's debts in a partnership. Characteristics of a LLC, about the same as a partnership, but you have limited liability. You can read those. But here is what starts this chapter out. Yes.
Is this gonna be on the test coming up? Any of this?
In a multiple choice question, you may have a characteristic of a partnership, yes. Now, journal entries to set up a partnership, yes. Now, if we have two proprietors, Jonathan and Co., they both had some kind of business. And they decide to combine, all right? What do you put on the books for store equipment and merchandise inventory? You have it appraised, don't you? And you put the appraised value, the current market value, not somebody else's book value. Remember, we're going to a new set of accounting books for a partnership. And it's up to the two proprietors to close theirs out. LLC, the same. All right. It would have been easier if Jonathan had sold his proprietorship or all of his assets and Co had sold all of his, and they started a new partnership by putting in cash. All right, income or loss of a partnership. If there's no agreement, it's 50-50. We went over ratios. We went over based on services, based on capital, based on a ratio, and we've worked out many different types of partnership incomes. All right. Then we had to make those closing entries, and I like the way they've done it. They changed it from the 26th edition to the 27th. They make a closing entry easy. Before we had to debit all the revenues and credit income summary. We had to credit all the expenses and debit income summary. Then we had to put income summary into capital. Don't do that. Easy now. Debit revenue, credit expenses, and credit equity. All right. Whether it's capital equity or whether it's members equity. The LLC is no different from a partnership. So learn one, you got the other. Now drawing, we take out the drawing. It's debit capital and credit drawing. All right, we've done this based on salary, based on interest. All right, assume that the partnership agreement for Stone and Miles provides the following: a monthly salary to Jennifer and a monthly salary to Crystal. Interest of 12% on each partner's capital balance. Remainder you divide it equally. All right, let's all practice this one time. We practiced this the other day, so we're not going to take a lot of time in class to practice it. Let's say the net income is $60,000. All right, now divide that. Take this information and work it out and tell me how much Jennifer gets and how much Crystal gets. I believe the whole basketball team's absent today, aren't you? And the baseball players are absent today. Folks at home should be practicing the same thing that we're doing. On my room down here.
I mean, I get the 35%.
Okay, let's look at this one. If I've got enough room here to write it. Now Jennifer gets 5. And Miles gets 4 meals. All right, that's salary. That's equal to 9,000. Now we still got 51 to give out. So let's give interest. What percent interest are we giving? 12. So what is 12% of 160,000, Carson?
$18,200.
All right, 19.2. Let's say give you, I think, not close, but what's the interest on 120,000? How much?
15,400.
All right, 19.2 and 14.4 is how much? Is that 33.6? All right, now we've got to make this add up to 60,000. So how much more do we need? How much do we have left? There's 33.6 plus 9. That makes, looks like 42.6. And what's 42.6 from 60? And how do we split that 17.4? And what is equal? 8,000 what? All right, when you add up each partner's capital here, that's what you put into their capital account. Should have to know the revenue and the expenses. All right, so hopefully you're getting a handle on that. Now, any questions? Okay, good. That means you're experts. Now here, in this example, they had 150,000 net income. I gave you 60. Go back. Okay. I gave you 60, but they're giving you 150. Got it? Okay. All right, here You've got their annual salary allowances. Now over here, what did I do? I did it for a month, see, right? We did it for a month, 60,000 this month. All right, but now over here, they're doing it for a year. Okay, so the annual salary allowances and then the interest expense, now that adds up to 141.6. They have 8,400 to split equally. Now, when we're looking at annual, we've got to do those closing entries. We debit revenue, credit expenses, and credit the 150,000, which is 83.4 and 66.6. Now that wraps up the closing entry for a partnership. I thought it might be a student asking a question, but it's not. All right, now if allowances exceed net income, I went over this yesterday too. Net income was 100,000, but that adds up to 141.6. It's going to only add up to 100,000, so we've got to put a minus 41.6 and split that minus. So this is a minus 20 and a minus 20. So a minus 20 from 79 is 58.4. So that's if you had, they still made money, but we got to go according to the partnership agreement. So interest to start the partnership, splitting income, and making those entries. So now we got to go to omitting a partner. Third concept in this chapter. Now we covered that quite a few times yesterday. And right here we're going to omit Joe. We're going to give him 20,000 of our equity. And we're giving up 10,000 of those paid Nathan and Tom. He could have given more, he could have given less. Now that's one way to get into a partnership.
They have to sit down and come up with a new agreement too.
Sure they do. New agreement, yes. And how they're going to split. Now, the best way to take in a new partner, just say, give the partnership some money, we'll give you capital. Give us 20, we'll give you 20 capital. That's the easiest way. Other way, you can purchase it. Now, in another way, the old partners get bonuses, contributing assets to a partnership. Here, we're giving inventory. Now we're revaluing inventory. Sometimes when you take in a new partner, especially if you're going to give him a percent of the partnership, you'll reevaluate. Now the inventory was worth 3,000 more. It was appraised for 3,000 more. The market value is 3,000 more. Now these two old partners were splitting 50-50, weren't they? All right. In case of equipment lost $5,000. So we credit equipment 5. We get rid of the accumulated depreciation, and the old partners lose 500 apiece. So that equipment is worth less than what it was on the books for. That's revaluing assets. Now we're going to omit Nelson here. Nelson invested $45,000 in the business. Ownership for prior to the investment, land was revalued to a market value of 260, up from 100. So you got to put that 100, revalue that, put 60 in land. Now these two partners split 1/3, 2/3. That's 20 and 40. Now you're going to let Nelson put his money in and give him 45,000 capital. That's an easy way too. But get those other assets, especially equipment, merchandise, inventory, up to par.
You don't get cash, you just get sick in the business.
Yeah, oh yeah, well, in this case, Susan, the business gets the cash. The new partner gets the equity. In this case, land, well, it went up in value, didn't it? And the old partners has more capital now. You know, it wouldn't be right if you had a business and you had a building worth 100,000 at the time, 20 years ago, and I come in on half of that building when its values went up to 160,000. It wouldn't be right for me to come in on 160,000 so that extra 60,000 should go to the old partners. In some cases, we give a partner a bonus. We pay more than what we're getting equity for. And in some cases, you see, this little example explains a lot of things. Jenkins had capital, Helen had capital. Now Diaz is going to put in 31. That makes 75. But we're going to give Diaz 1/3. 1/3 of 75 is 25. So how much is Diaz putting into business? 31,000. And he's getting capital of. Why would you want to do that? Nancy, why would you want to pay $31,000 to get 25,000 in capital? Anybody? Gotta be a reason. What's the reason you'd do that?
Investment. She wants to see this company will grow.
It must be a good company. You must think the company will grow. You must think you'll get a good income. Yeah, there's a reason you'd pay more for what you're getting. So here's the journal entry. Debit cash 31, credit his capital 25, and give the other two capitals a bonus. All right, now, we'll review real quick withdrawal of a partner. Now, sometimes you might want rid of a partner and you give him extra money to get him out. It might be a big hurt, to the business. The best way, if you've got 25,000 capital, take 25,000 cash and credit your capital. Everything's clean slate that way. But the partnership might not want to give you 25. They may only want to give you 20 to get rid of you. Or they may want to give you 40 to get rid of you. Then the old partners lose or gain. Remember, when a partner dies, you can keep that same partnership going, but you got to take care of the books up until that time. But usually the death of a partner does partnership liquidation. I want to show you one entry. Now this I expect you to do on tape. Liquidation. All right. You've got the balance sheet up here at the top. Assets is equal liabilities plus capital. That's a balance sheet. You sell your assets for $64,000, but you had them on the books for $72,000. So you took an $8,000 loss. And we split that at a 5-3-2 ratio. Now, you pay off your liabilities. That should leave enough cash to pay your partner. All right, now that's a quick review of this chapter. Now, the other day I assigned you exercises on this chapter. And let me repeat those. What were they, Cole? The exercises on this chapter.
It was 2 through 14 emails.
All right.
2 through 14.
These were due today. Exercise what?
2 through 14 the emails.
2, 3.
2 through 14 the emails.
All right, he said 2 through 14, the eve. All right, that was due today. We will cover those Tuesday. All right, now there are other important exercises in this chapter. So this should have been done for the day, so yeah, I'm gonna add on a few for the weekend. We gotta get up to this, distribution. We need to do 16, withdrawal of a partner. All right, now liquidation, we need to do number 20. We need to do 22. And then problem 1. All right, now that's your new assignment on this chapter. And hopefully everybody can get caught up. You've got a 4-day weekend to do so. All right. You folks at home, try to keep up, and I am stopping the recording, so everybody have a good weekend.